Hello, I'm Chris Didier, and welcome to the Bear Generational Wealth Group's third quarter market and economic update. So I'm going to go through a lot of information fairly quickly in probably less than 20-minute presentation. If anything I say should raise a question for you, please feel free to reach out to me. My email is right there, cdidier@rwbear.com. Okay, let's get into it. So how did we do in the recent quarter? Well, most risky assets did okay, with the exception of small cap. It was led by emerging markets. Emerging markets had a very good quarter, up about 5%. Large cap, no surprise, came in second here. That's been leading all asset classes for the year. Less risky assets, not so good over here, kind of flattish for the quarter, and pretty much slightly negative to flat for the year. The big shining spot so far this year has really been gold and silver. Silver in particular up 31.2% for the year. Very strong in the quarter, and that's something that we see continuing as we get into the next quarter. Where are we? So we always like to start, well, where are we within the market cycle? And as you can see, we kind of been moving up here through the year. That's where we were at the beginning of the quarter. We continue to move on up here. And this is where we are at the beginning of the third quarter. We expect that we're just going to continue kind of going up to this spot of euphoria. And that's a place where we want to reduce risk exposure and increase liquidity. So we're actually recommending to our clients that we take advantage of higher market valuations to reduce risky asset allocations by 5%. So we want to reduce by 5%. And so we'll be doing that as the quarter moves on. Okay, so why do we say we're moving that area? So we're up here right now. This is the individual investor allocation of more risky assets. The blue line that runs here through here is sort of the average allocation portfolio. Think of that as being close to that 60-40 type standard allocation. When we get up here, so above 70% where we are at the end of June, that's an area where typically in the past we see some pretty significant correction in the markets. This is sort of rare air, if you will. And so that's investor over enthusiasm. So we watch that as sort of an indication of where we are in the market cycle. In addition to looking at valuations, there's a lot of measures of valuations that we look at. One we liked for a long time is the cyclically adjusted price earnings ratio. That's because we have data that goes back to about 1900. So a lot of data. We're showing you data here on since 1990. The CAPE ratio is the blue line that kind of runs through here. This is where we are at right now. The key takeaway on this is that when we're above this red line, expected return for a new dollar investment is just below 4%. So that's not all that attractive. So much better if we get closer to the gray line down, where we're down lower, and the expected return goes up to about 11.5%. So that tells us that a new dollar of investment, we don't know what the ride's going to be. It just says basically that, you look back 5 years and that would be the expected return. So it's a good time to start raising a little bit of cash. Okay, what's been driving the market? Well, earnings have been driving the market. And this is the trailing 12 months has kind of been climbing up, for a while here. We had this little pullback in earnings, but now it's starting to move higher. Most analysts are calling for earnings to increase more broadly, so maybe some compaction around the Magnificent Seven, which has been driving really the bulk of the earnings growth so far for the S&P 500. And so it's expected that that's going to spread out. So we're looking for, at least the analysts are looking for earnings growth in 24 of 11.2%, in 25, more like 14%. So pretty good earnings forecast. And that's something that's driving the market higher. One thing that's interesting to us is you look at the S&P 500 right now. So the S&P 500 is now trading above 5,600. Okay, so at the beginning of the year, the typical analyst on the street was looking for about 5,100 to end the year. And of course, analysts have raised their expectations. We've gotten to 6,000 on the high side, and the low side is still 4,200. It's interesting because the data basically says that over the last 20 years or so, that 75% of the time we're either above the highest expectation on the street or below the lowest. And since we're getting closer to that higher level, in spite of the potential for growth in earnings, the upside just is not as strong as the outside. So we'll continue to rebalance at a lower weight and continue to monitor the overall allocation of more risky assets. Okay, so this is the big thing that continues to drive the markets, has been driving the markets and the economy for that matter. This is cash in the system. So historically, cash in the system, the economy has run about 75% of GDP. That's going back to 08. You can see obviously with the pandemic, cash went through the roof, and that's because of all the stimulus that was added, and it's still sitting there. So it come back a little bit, when we were kind of in fear of recession, but then this is just taken off again. And so we're sitting at $2.9 trillion relative to a $27 trillion economy. That's a lot of excess cash, and that's a lot of cushion for both the economy, from the consumer standpoint, and also for the equity market. And this is particularly important. And when you think about over the last really since 1998, there used to be 8,800 issues, individual stocks that traded. Today, that's 5,600. So there's just not as many stocks out there. So that's more money chasing fewer stocks. And with the IPO market being somewhat absent over the last few years, there's just not new issues coming on the market to suck up any extra cash. And so that's obviously one of the things that we think are supporting the overall equity market. Okay, from an economic standpoint, this has just been the consumers just continue to be super strong. One of the things that is indicative of that strength is just really you look at what they're buying. It's discretionary and it's recreational type goods. Those are just very strong, still solidly above pre-pandemic levels. And that's with we get a lot of people asking us, well, aren't consumers taking on a lot of debt? And you do, hear reports and CNBC and other networks talking about, gee, we've got record levels of consumer debt. Well, is that really a problem? It would be if the consumer didn't have the ability to service that debt. And right now, the debt service as a percentage of disposable income is sitting at a relatively historical a low level, 9.8%, well below a historical average of 11%. So the consumer is in a good position to keep spending. They've got cash. Really, it's on the bottom end of the economic spectrum, if you will. So people, it's really kind of a haves and have-nots. And so the haves have financial assets. Those have been continuing to go up. Housing prices continue to go up. Stock portfolios go up. The have-nots, they don't have those, and stimulus has run out for them. So that's creating some sort of interesting dynamic in our economy. And we'll see how that plays out. But probably going to have some sort of issue with the presidential election coming up. And we're not going to talk too much about that because there's enough being said about that all over the place right now. We do are paying close attention to how that's going to affect the mood in the country, and it probably will weigh on it. We've already seen consumer sentiment for the last few months start to decline. So we'll watch this consumption expenditures very closely to see what sort of impact that may have on the economy, or sentiment may have on the economy, and that may cause some softening. But right now, it's pretty much been a freight train. Okay, so when we think about what are the things that are troubling in the economy, it's really continued to be inflation. Inflation has remained very sticky. So in spite of the recent inflation numbers, people have been talking about, well, they're coming down. Well, they got down to, they're still at 3%. So that doesn't mean we're in deflation where inflation has gone away. I mean, prices have gone up quite a bit. Now, energy, which is the light line here, so this is electricity. And as we talked about in last quarter, I mean, most people don't really think about electricity that much. It's like water. It's like, ubiquitous. And so, but to see the electricity prices now up to where they are as of June, 25%, versus where they were 3 years ago, that's not coming back down. So the prices that have gone up are up, and they're, whether they go up another 3% or not, is still a higher price and harder for consumers to deal with. And if wages haven't kept up with that, that makes it difficult, especially for those on the lower end of the economic spectrum. We've seen this. We talked a lot about oil as well. Oil's kind of going sideways. It looked like it might come down a little bit, but it's kind of firming up. And with OPEC continuing to cut back supply, with our own producers here domestically sort of cutting back supply, and demand maybe potentially picking up around the world, we think oil prices are going to remain fairly sticky. And in general, the combination of these two things are going to make inflation fairly sticky. And our own, like our manufacturing business outlook survey that we look at as an indicator of where inflation might go. It's also kind of going sideways to slightly up now. It is showing that purchasing managers are starting to see higher prices, and so that is something that we would expect to see as time goes by here. And maybe the Federal Reserve does cut interest rates, but that may be something that just really, with all the cash out there and these underlying sticky factors for inflation, just causes inflation to reaccelerate. And that's something we'll be watching for over the next year or so, because 87% of the time when you have historically speaking, when you have a spike in inflation, it's followed by a second spike that's even larger than the initial spike. So we are watching for that, and that's something that is of concern we go forward. But the fact that inflation has come down, at least broadly speaking, puts the Federal Reserve in a better position to maybe do something with rates. And so we'll talk about interest rates a little bit. This is the where interest rates were prior to the beginning of quantitative easing at 5.4%, and with all the money that the Federal Reserve spent as part of their quantitative easing program, buying government-backed securities, buying government bonds, that really brought interest rates down to about that 2.57% on average number over the last 15 years. But when quantitative easing ended, we saw what happened to rates, started going back up. So barring another round of quantitative easing, we're expecting rates to come back and be more in this, more like the 5.4% average that it was historically. So what does that mean? Probably rates are going to be somewhere between 3.5% and right around 7%. That would be like the average for that. And so that's where we expect the 10-year to trade. I talked a little bit about the Federal Reserve lowering rates. There's an expectation that's a 90% probability about roughly right now that the Fed does lower rates during their September meeting. So that would probably be like a quarter point. The curve still remains inverted. And so what we're looking for is the uninverted yield curve to materialize. And that's would be an indicator that potentially recession could be around the corner. And so that means that happens when the low end of the curve is now normal. So that means low rates are lower than the 10-year rate. And so it's going to take a little while for that to happen, but that could happen quickly if the Federal Reserve gets more aggressive than what they currently are stating they're going to do. Okay, so what's one sign that in addition to the yield curve, that we could be looking at a slowdown in the economy or some recession coming? So the gray bars here, that's recession. This is unemployment rate going back to 1948. And you can see, so each time before the recession, unemployment starts ticking up ahead of the big spike in unemployment, so when we get into recession, that's when you see the big spike. So we're seeing that tick up now in unemployment, and that's a crack in the overall economic outlook. And so will that be followed by a recession? We've been talking about this. We think if there's going to be a recession, probably happens after the presidential election, so probably happens in 25. And so that's just from a historic standpoint. Most recessions happen in the first year of a new president's term. And that's really, it makes sense to us because that's when all of the stimulus has fallen off. So an incumbent president, there's a lot of things they can do to keep the economy going. And the current administration has certainly been doing that with things like trying to keep oil prices low, keep for student loan forgiveness, keeping more money in the system. And that tends to go away after a new president is elected. So what's the outlook? I mean, one of the things that may keep the economy going and keep the U.S. from going into recession is really what's happening around the rest of the world. I mean, so this is Asia, so includes all Southeast Asia. It's supposed to slow down this year and into the following year, into 25. These are IMF data. This looks a little bit funny because this is real GDP, not nominal. So it takes in consideration inflation rates in the various countries. The one thing to note here is that in June, and we hear a lot of negativity around the China economy, but in June, the manufacturing output was at the fastest pace in the last 2 years, and the economy seemed pretty and broadly stable employment. So that's really not that bad, and we're starting to see some indication of pickup again in Chinese economy. I mean, the demand for copper, demand for oil, those things have been picking up, and so that's a good indication for the Chinese economy. Here's Europe. So Europe was pretty much much of Europe, Japan as well, UK, France, Germany. They were in recession when the US didn't go in recession. China, you could say, was probably in some slowdown of an economy, call it a recession. And that's expected to pick up and really be a pretty decent place over the next 2 years. While the IMF is saying the US is expected to slow down this year in 2025. Whether it's just a slowdown or whether we dip into more of a recession. If it is a recession, it's going to be a mild one. And it's going to be mild because the rest of the world's kind of already gone through this and is now picking up, which we're showing you here. And in addition to that, that's all that cash that's under there. But that we would expect to see some sort of potential slowing next year, and we'll watch for signs of further recession in that. And if we start to see that, we would want to be more underweight than the 5%, maybe go to a 10%, but we're not there yet. Right now, we're just looking for the 5% because of valuation. So it's really driven by valuation. So where are we from a conclusion standpoint? We've been, like I talked about, moving along in the cycle, headed to euphoria. Euphoria is a time, a place to reduce exposure to risky assets and increase liquidity. Cash remains very strong in the system, and that's something we expect to see. Consumers continuing to spend at record levels, but sticky inflation is going to be a problem because that ultimately means that interest rates will go higher, and if inflation takes off and starts to go again, and really it makes sense to us that if the Federal Reserve starts to cut rates, that's going to create a lot of excitement, a lot of stuff happening then in the economy, and that's really going to create demand. And if you've already got sticky underlying inflation, that sort of opens the door to more inflation that we have. The rest of the world is showing signs of improvement. This may help the US actually avoid a recession, or at least if we go into recession, make it more of a mild recession. That's what we think. And as I said, labor market's showing signs of cracking. That's going to be something to keep an eye on. Because that usually happens right before recession. So what do we suggest people do now? Really look and be very opportunistic in this and reduce allocations of more risky assets to 5% underweight. Really, it's more of a call on valuation and investor enthusiasm than it is an economic call. But if we get to, we're at these kind of valuations and we start to see the economy deteriorate, we'll probably go to a more underweight position at that time. So with that, please feel free to give me an email with any questions you have or a call. Happy to go over that and happy to be a resource in any way we can. Till next time.